Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. Today, our mission on the deep dive is really to cut through all that noise. The latest financial news, market moves. We're diving deep into what's shifting things in tech, global markets, monetary policy. We've got a whole stack of top financial publications here.
Yeah, it's going to be a really interesting look, and the sources are pretty diverse today. Market analysis from places like CNBC, MarketWatch, but also those crucial geopolitical reports, broader outlooks from Bloomberg, Reuters. It lets us see how these, well, seemingly separate things are actually connected. The goal is to give you that holistic view, pull out the really key insights shaping things right now.
Okay, let's unpack this then. We're seeing some, well, really interesting moves in the chip sector, specifically with Advanced Micro Devices, AMD. Their shares jumped pretty significantly after dipping a bit last week. What's really driving this optimism? What's the story there?
Well, yeah, exactly. We saw reports in CNBC and MarketWatch. AMD stock climbed, what was it, nearly 9 to 10% on Monday. And it wasn't just random. You had analysts like Piper Sandler, mentioned by CNBC, lifting their price target.
Right.
Went from $125 up to $140.
Okay.
Their thinking is this expectation of a strong snapback for AMD's GPU business, looking ahead to Q4. And a big part of that is they're moving past the bulk of that $800 million charge, the one tied to the U.S. export license rules for China and elsewhere.
Right. Getting that behind them.
Exactly. So the focus shifts back to innovation.
And it sounds like their new products are a huge part of that renewed buzz. Hints at the longer strategy. We're talking the Instinct MI350 AI accelerators, and this seems key, the Helios full-server rack system. Both CNBC and MarketWatch pointed out Helios ties thousands of chips together, vital for big AI customers, cloud companies, LLM developers, that sort of thing. I mean, even Sam Altman from OpenAI called the products totally crazy. That's pretty high praise.
It really is. A critical endorsement.
End of that.
And MarketWatch noted investors are now sort of chasing these developments.
Yeah.
The reaction last week was a bit muted, maybe partly because of those rising geopolitical tensions between Iran and Israel heating up.
Oh, okay.
But now, things seem slightly calmer, just for the moment, in the Middle East, so investors can refocus on the tech itself and the opportunity. Zacks Investment Research highlighted something really important, I think. It underscores AMD's position. They're looking to gain market share because, frankly, NVIDIA can't meet all the demand.
Right. The market's just that hungry.
Exactly. There's a vacuum, and AMD wants to fill it.
So it's not just competition, it's also filling that massive demand gap NVIDIA leaves. But, I mean, how does AMD really stack up? It's fierce out there. Bernstein analysts, MarketWatch reported this. They sound modestly encouraged. But they still see NVIDIA's data center opportunity as enormous and still early, big enough to cover China bans even. They suggest AMD's MI355 chips might struggle against NVIDIA's rack stuff, and the next MI450 series is aimed at NVIDIA's next-gen Vera Rubin. Sounds like a tough race. Are they really set to fill that gap or still playing catch-up?
Well, that's the key insight for you, the listener. This AI race, it's probably not zero-sum. Even with NVIDIA way out front, AMD's move with these integrated racks, like Helios, it's not just about catching up. It's capitalizing on demand so huge, it genuinely creates space for multiple winners.
Yeah.
The market's expanding that fast.
That's interesting.
So yeah, there's room for both to thrive. It suggests maybe a more diversified AI hardware landscape than just winner-take-all. And focusing on integrated solutions like Helios is smart. It addresses that real need for scalable AI infrastructure.
That's a great perspective on AMD. Okay, but speaking of fascinating dynamics, this interplay between geopolitics and markets right now, it's gripping. Beyond tech buzzing, you've got these global shifts really hitting home. Israel, Iran, trade policies. What are you seeing across the board?
Oh, absolutely. The market reactions were immediate. According to CNBC, U.S. stocks initially climbed Monday. There were hopes for an Israel-Iran ceasefire.
Right.
But then, Tuesday, futures fell. President Trump's comments urging evacuations into Iran, leaving the G7 early for much bigger things, that signaled escalation. Reuters and others covered that widely.
Yeah, I saw that.
And in Europe, Asia-Pacific, markets were mixed or lower, as CNBC reported. But here's the really surprising thing.
What's that?
Israeli stocks, amidst all this conflict, they actually hit new all-time highs.
Really? That is counterintuitive. How does that happen? Is it just unique resilience, or are investors seeing something else?
It's a puzzle.
Yeah.
Maybe resilience, maybe something deeper about the long-term outlook despite the immediate chaos. It's definitely worth watching.
Absolutely. And speaking of surprising moves, let's talk safe havens. Gold. It's surged, what, 30% year to date?
Incredible, yeah.
Far outpacing the usual suspects, yen, Swiss franc, treasuries. CNBC highlighted this. So what does this tell us about what safe even means now?
That's a huge question, isn't it?
Yeah.
Especially when the traditional ones aren't performing. Gold appeal, you see this in commentary from market experts, the World Gold Council. It's about freedom from government liabilities. It's seen as apolitical. No counterparty risk. Nikos Kavalis at Metals Focus put it well. Other assets tie you to an economy or government. Gold is separate.
Makes sense.
Plus, you've got central banks. They've added over 1,000 tons of gold to reserves for the third year straight. That's a massive vote of confidence.
Wow.
But it's not unanimous. Reuters reported on Citi's outlook. They see gold potentially dropping below $3,000 after Q3 2025. Weak demand, growth optimism, though they only give that a 20% chance.
So a contrarian view exists.
Definitely. It shows
Yeah.
the debate is ongoing about gold's role.
Okay. Now, oil prices. The conflict pushed them higher, naturally. Brent around $74.39, WTI $73.12 per CNBC. But then you have this fascinating long-term forecast from the IEA, the International Energy Agency. Bloomberg and Reuters mentioned it. They see global oil demand peaking by 2029 and China even earlier, 2027, driven by EVs, high-speed rail.
Yeah, and that contrast is stark, isn't it? You've got immediate geopolitical risk pushing prices up now, but the IEA sees a well-supplied market coming. Meanwhile, OPEC Plus thinks demand keeps growing till mid-century. Totally different views.
So how do you square that circle?
That's the big question for all of us, right? How do these short-term shocks balance against powerful long-term trends like the energy transition? It's like trying to plan a long road trip while there's a hurricane outside, but, the forecast says sun later. Short-term chaos versus long-term direction.
Good analogy. And on the trade front, another layer of complexity. Trump's tariffs are back in the headlines. According to CNBC, there's talk of a 50% tariff on steel, a 10% baseline on other imports that seems here to stay, quoting Robert Haysworth at U.S. Bank Asset Management.
Right.
We did see that UK-US deal at the G7, lower tariffs on cars, zero on aerospace parts. But Reuters noted the Japan deal is still unresolved. Nomura analysts think that could hit Japan's growth by 0.3 percentage points annually. Paints a picture of a pretty choppy, maybe more protectionist trade world.
And connecting that back for you, the listener, it's crystal clear how geopolitics directly shakes market sentiment, commodity prices, trade flows. It creates this complex, sometimes really unpredictable risk environment. Every headline about international relations can genuinely impact your investments, even cost of things day to day.
Okay, so we've covered the AI, gold rush, global tensions. Let's pivot now. How are central banks and specific industries reacting? Starting with Japan, what's the latest there?
Right, the Bank of Japan. Their decision Tuesday, covered by CNBC, Bloomberg, it was highly watched. They kept rates at 0.5%, as expected. But the big news was announcing they'll slow down buying government bonds starting next April.
Ah, okay. Step towards tightening.
Exactly. It's aimed at market stability with all the global uncertainty, growth risks. But it still signals that path to normalization, even with trade tensions and the Middle East situation simmering. It's subtle, but a clear message. They're being cautious, unwinding that ultra-loose policy very slowly.
And we saw the immediate effect, right? JGB yields ticked up, the yen strengthened a bit, according to CNBC. Shows that balancing act they're performing, tightening, but trying desperately not to destabilize things, especially with the tariffs and conflict risks out there.
It's a very delicate dance, absolutely. And beyond these big macro stories, you see fascinating micro trends playing out. Like Investopedia highlighted China's prominent 10. Goldman Sachs sees them as China's answer to the Magnificent Seven.
Oh, interesting.
Yeah, Tencent, Alibaba, BYD, companies like that. Poised for maybe 13% annual earnings growth. Friendlier government stance, AI investment expanding internationally. Could be a sign of a Chinese tech rebound.
Oh, okay.
Then there's SoftBank's huge AI bet. Bloomberg reported they sold $4.8 billion in T-Mobile stock. Why? To fund these massive AI plans, like a reported $30 billion investment in OpenAI, that Stargate data center project. That's a major strategic shift, doubling down hard on AI.
Wow, $30 billion. And what about that U.S. Steel deal? That sounded unusual.
Yeah, the golden share thing. MarketWatch reported U.S. Steel shares surged after Trump approved Japan's Nippon Steel investing. But the unique part is the U.S. government holding a golden share. To protect jobs, HQ, stop plant closures.
That is a departure for Trump, getting involved in private company deals like that.
It shows a willingness to step in for strategic reasons, especially in key industries. And one more quick one. Uranium stocks. CNBC highlighted the surge there. The Sprott Uranium Miners ETF, up like 15% in June.
Why uranium?
Demand for reliable power, especially for data centers. As the next CEO said, they can't go down for a fraction of a second, need that stable baseload power.
Got it. Makes sense with the AI boom needing power. And we saw other moves too, right? Big tech still strong.
Yeah, CNBC noted Microsoft, IBM, Palantir hitting new highs Monday. So continued strength there. And a surprising jump in agriculture. Food companies like Bunge, Archer Daniels Midland.
All right.
That was after China approved Bunge's merger. Shows how specific regulatory news can spark moves.
So it really all ties together.
Exactly. It reinforces that takeaway. Financial markets are this incredibly complex tapestry. Geopolitics, tech breakthroughs, central bank moves, they all weave together, creating opportunities but also challenges. It's about seeing those connections.
This deep dive has definitely given us a lot to chew on. I mean, from the AI chip race where maybe multiple players win to the shifts in safe havens, gold surge, central banks walking that tightrope, it's a lot. So as you navigate the headlines tomorrow, maybe think about how these bigger trends could ripple into your own financial world, your investments, the economy around you.
Indeed. The markets are always dynamic, always throwing curveballs. The key really is looking past just the immediate headline. Understand the underlying forces connecting those dots. That gives you the richer perspective.
So a final thought then. Given this shifting landscape for safe havens and the, well, insatiable demand for AI, what's the next unexpected catalyst going to be? What could reshape how we think about value and risk next? We'll see you all tomorrow morning with new headlines from major financial magazines.